Happy Monday, everybody. I hope you had a great weekend. Today is December 19, 2022, and this is your Monday Market Update. I am concerned this was going to be a little bit longer, but there's a lot to wrap up, so please watch until the end. I'm sorry it may be a little longer. I'll do my best. Last week was a heck of a week, and that's saying a lot considering what's going on this year. I guess the good news is the year's almost over. Let's review last week and preview this week. On Monday, stocks started on the higher side. They reacted to China still moving away from the zero COVID policy, something we've been talking about for a while as a key to the market bottom. This is good news, and we'll have to see how it'll play out. The good news, as China reopens, there's a positive effect on global growth, one of the biggest fears of this market. On the other hand, China is opening up and reporting a big spike in new cases, the most since the beginning of the pandemic. Not good news for the opening. The market continued to roll up higher, prepping for the Tuesday CPI number, and the New York Fed forecasts were somewhat dovish. Stocks closed in the higher ticks. Clearly, the market was anticipating a soft CPI print and the dovish Fed meeting. Oil up almost 3.5%. Keystone Pipeline closed due to one of the worst leaks in its history. Overall, the S&P and Dow up about 1.5% each. The Nasdaq up 1.25%. Looking for two in a row, as I've said before, on the way to a winning streak. The stocks on Tuesday took off again on cooler than expected CPI numbers. The numbers as a whole indicated some of the inflation in the right direction, but before the day was out, the market gave back most of those gains. Highs were hit within the first 30 minutes of the open, as the market did pull back to position for the Wednesday Fed announcement. It was not a coincidence that the Fed whisperer at the Wall Street Journal, Tim Rose, wrote the inflation trends may cause some complications with that 5% terminal rate issue. May have to be higher. That took some of the wind out of the sails. CPI coming in softer is good, but does not solve two of the biggest problems. Valuations are still too high, and inflation is still too high. We'll have to see how this market handles these issues going forward. Overall, the Dow was up 1/3%, S&P up 0.75%, the Nasdaq up 1%. As Wednesday got started, as expected, we had a hesitant market, positive early, but a bit cautious. UK inflation coming down, China opening more. Overall, there was a positive feel. All while the market was waiting until the 2 o'clock Eastern, and then the FOMC raised rates another 50 basis points as expected to 4.25% to 4.5%, highest rate since December of 2007. This was very much telegraphed, so there was little movement, even as Powell spoke for most of the press conference. But overall, before the end, if you recall last time at bookings, he didn't punch the market in the face, but was neither hawkish nor dovish. This time, by the end, he was much more hawkish than the market feared. Used comments like, "We'll not be cutting rates in 2023 and still have a lot of work to do, especially in the labor market." The Fed is forecasting for a much higher rate next year, and in case that scares you, just know that they do not have such a good track record with this. In December of last year, just 12 months ago, they forecast 0.875% would be the rate now in December of 2022. And yes, today it is 4.25% to 4.5%. So close, just not quite there. At the end of the whipsaw day, the Dow was down less than 0.5%. S&P down just over 0.5%. The Nasdaq down 0.75%. Thursday stocks got worse as the morning wore on. Futures were down overnight on China eco news. Then it just got worse as the open got closer. Retail sales came in light, and overall eco news in the U.S. was bad. Also, jobless claims were not any help. The stocks gapped open lower, and even after a few attempts to stabilize and even bounce, no success. Selling at the close, and the markets ended near the lows. Dow was down 2.25%, S&P down 2.5%, the Nasdaq down 3.25%. Friday saw stocks hold on to their recession fears, and the market was in selling mode again. Note a few things. One, no more big data before the end of the year. Two, depending on who you read, this was triple or quadruple witching day, which regardless of which it was, it added volatility. The markets put their second straight week of losses in, and by the end of the day, the Dow was down just under 1% for the day and about 1.5% for the week, making it almost down 5% for the month. S&P was down over 1% for the day, down over 2% for the week, bringing that tally so far this month to down over 5.5%. The Nasdaq was down about 1% on the day, 2.75% on the week, and down over 6.5% for the month. Let's look ahead into the coming week. We'll have some high-profile earnings and some lower-profile eco data. Everything will be looking at everything we looked at these days. Everything will be looked at these days. But I think you'll see as we stay focused on the labor market, the focus will be on the growth information, earnings, and other eco data that supports that. We know that the Fed wants to get the labor under control, and as I've said many times, as long as we can slow growth without falling off a cliff or reaching stall speed, we'll be okay. That will be the key to watch for. We'll hear from FedEx, Nike, General Mills, Carnival, Micron, Paychex, and CarMax, to name a few. The biggest news will come on Friday with the PCE eco data. As I've told you before, this is a Fed favorite. We will get another Q3 GDP number and the University of Michigan survey numbers. As I've said, it's the end of the year. There's a lot going on. Note that this is not like Thanksgiving week where people are off the desks. By the evidence that the market is open on the last day of trading all the way till the end of the day, full day. This year it's the 30th, so note that there is still a lot going on, but no major catalyst unless there's a surprise. Who knows in 2022? As we go with the last Monday market update, since next week will come on Tuesday, since the market will be closed on Monday for the Christmas holiday. Let's review where we stand going into the last few weeks of the year. The Dow Jones Industrial Average down 4.83% for December, 10.9% off its record high, down 9.4% for the year. The S&P 500 down 5.5%, 5.58% this month, 20% off its record highs, down almost 20% for the year. The Nasdaq down 6.5% this month, 32.5% off its highs, down 31.5% for the year. And to put the opinions into perspective, just to put some numbers out there in case you thought this world was not divided. Oppenheimer says the S&P 500 could surge 12% in 2023, cooling inflation and China reopening. On the other side, top technical analysts at TD Ameritrade watch for the next move, 19% down. Move before we see the bottom. And then Mike Wilson at Morgan Stanley still thinks we'll see S&P 3000 in 2023. Okay, I guess the only thing we won't have this week is the Fed heads on tour, at least not in any of the research that I have does it say they'll be out there. We'll be busy doing all the last-minute planning for the next few weeks. Please call me with any questions. As the end of the year comes, we'll have to stay nimble, and we'll see what tomorrow brings. We'll talk soon. Have a great week.